Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. On today's episode, we'll be looking at the week's rate decisions, not only from the Fed, but the Bank of Japan as well. And in a moment, we'll be speaking with Vishal Khanduja, head of broad markets fixed income at Morgan Stanley Investment Management. First stop is Singapore and a chat with Bloomberg FX and rates strategist David Finnerty. It's always a pleasure to chat with you, David, particularly when we're talking about central bank moves. This BOJ decision didn't really come as a surprise, but boy, the reaction in the end, weakening to 158. Is this a little concerning, do you think, for markets?
I think you said the fact that they didn't change rates was not a surprise. What was a surprise was the markets were looking for basically Governor Ueda to throw a rate hike in January on the table, and basically he didn't sound that hawkish at all. In fact, you could argue it's more like the May decision it could be, because he kept referring to spring wage negotiations, which is essential wage negotiations. So given that and the expectations, therefore, the market had to dial back rate cut expectations, you've seen dollar yen rally on that, particularly because remember the Fed was very hawkish as well. And there's no surprise that after that decision, particularly after the press conference, a lot of hedge funds basically piled into option bets, particularly digital option bets, that dollar yen could go to 160 to 165 in coming weeks. So I think because the irony is because of the dovish rhetoric, dollar yen's weakening, which of course ironically forces BOJ's hands to actually tighten sooner.
So where is the level where the market really has to be concerned about intervention? Is it well above 160?
No, I think that's a good question. I would say around the 160 level is where you start certainly hearing. You'd expect the Ministry of Finance to come out and start using the rhetoric that they may intervene, but certainly around 160, certainly the recent high of just under 162, then that would definitely be certainly territory you'd be worried about intervention. But I would say, the MOF and BOJ, they don't want to make it too obvious whether they'll intervene. So I think anything around 160 plus is for them certainly intervention territory, and definitely above 162.
It doesn't make the BOJ's job any easier if you've got the Fed adjusting its outlook for rate cuts in the new year. Right now, we're expecting maybe 2 in 2025. The prior projection from the Fed was 4. I guess in terms of the path for the dollar over the next 12 months would be that it's going to remain very firm. Am I right?
Well, certainly, I think at the moment the attitude would be bullish on the dollar without question. I think the catch is over. You look over 12 months. I mean, the market has been very hawkish in terms of its pricing. You said it's not even really priced into for next year. So the question is, based off if Donald Trump comes out and he does impose tariffs, and what sort of policies do get passed? Because remember, a lot of his policies do have to go through the Senate and they have to go through the House. So there's no guarantee they'll be passed. Look at the problems they're having passing the funding bill at the moment. So I think the reality is what does actually happen. And is that as hawkish as markets expect? If it's not, and it doesn't have as big an impact on inflation as perceived, then obviously the market pricing will go, look, we're a bit too hawkish, we can be a bit more dovish, and obviously that would help curtail some of the dollar strength. But certainly at the moment, in the near term, you'd have to go, the dollar is, the risks are skewed towards more dollar strength.
And as long as we're talking about the flip side of dollar strength, we were talking about weakness in the Japanese yen a moment ago, but it was also the offshore Chinese yuan that weakened to a fresh one-year low yesterday in response to the Fed's change of heart. And then in Beijing, authorities were essentially forced to ramp up support for the yuan. Is that going to be something that we're going to see time and time again now going forward?
Yeah, I would think so. I mean, you look at the fixing, the PBOC sort of saying, okay, with it fixing around 720, that at the moment that's the line in the sand, which is really indicating they don't really want dollar offshore yuan or dollar onshore yuan to really go above 735. I do think at the same time, though, is if this dollar strength continues, then I think there will be pressure on the offshore yuan to weaken. Because what happens, ironically, is if dollar strengthening against other currencies and the yuan stays where it is against the dollar, then the yuan is actually strengthening versus these other currencies. So I think one thing to really look at is not just dollar yuan, but obviously the yuan against the CFETS basket, so that trade-weighted basket of how it's performing, given that at the end of the day, it won't want too strong a currency because it will want to support the economy. But as we've seen historically time and time again, it doesn't like these one-sided bets. If the yuan is to depreciate, it wants it in a slow, gradual manner. It doesn't want a very rapid depreciation. question. So even if it does get above the 735 handle, say, against the dollar, I do think it's going to be a slow grind at best.
Do you think there's greater risk now, particularly with the threat of U.S. tariffs on Chinese exports, that Beijing would favor gradual weakness in the currency?
I think as long as it's gradual, I don't think they'll mind too much. Again, I think they'll look at what other currencies are doing versus the dollar as well. So I do think you have to put it in the big picture rather than just focus purely on the dollar. But if it's a gradual decline and it's sort of warranted, i.e. higher interest rates and stuff, I think to some degree they'll allow that. But again, I don't think they certainly won't want a rapid decline, without question. And even if it's a gradual decline, I think the question is to what level. I mean, the 735, 736 becomes key level. They may let it go towards 750, but again, beyond that, I don't think they'll want this one-sided bet. So I think it's going to be a grind lower for yuan, but the PBOC will make sure it's hard that not everyone's just ganging up on it, shall we say.
We have to talk about South Korea. We know about the political turmoil in the office of the presidency. We've seen a lot of volatility in the Korean won, and the BOK, the central bank, trying to create a little bit more stability in markets. Give me your sense of what's happening with South Korea's currency.
I think certainly the risks are still towards near-term weakness. It's one of the worst performing nations this year. Obviously, political uncertainty is not going to go away anywhere soon, so that's not a positive for the currency. And I think just generally risk sentiment. I mean, everything's dollar at the moment. With the yuan weakening, the Korean won will be used to some degree as a proxy of that because China's a major trading partner there. Also, if risk sentiment on AI starts to deteriorate, then that would be positive to the won. So I'd definitely be looking at what U.S. equities do in the near term, particularly with the funding bill not being passed. Do U.S. equities say, okay, let's take some profits off the table? It's been a very good year there. Let's go to UN, lock some profits. If they do and start to equities weaken, then that risk sentiment will be another headwind for the won. So I think near term, if you had to be biased which direction it would go, you'd have to favor more weakness, certainly in the near term.
Thank you so much, David. It's always a pleasure. David Finnerty there, Bloomberg FX and rate strategist, joining us from the Lion City here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Joining me now for a little bit more on this week's central bank action is Vishal Khanduja. He is head of broad markets fixed income at Morgan Stanley Investment Management. Vishal joins us from Boston. Good of you to make time to chat with us, Vishal. Let's start with the Fed. Did it come as a big surprise to you that the Fed is now dialing back on expectations for rate cuts in the new year?
Not really, Doug. Thanks for having me on. I think the guidance was very clear prior to this meeting over the last 3 meetings that they're going to be data dependent. Data was telling them very clearly 3 meetings back that unemployment or labor market, which is one part of their mandate, is weakening. So they needed to cut from the very restrictive stance, 550. And they did over the 3 meetings with 100 basis points. And now clearly, I think the data is shifted towards a little bit more meeting the dual mandate and then now focus a little bit more on inflation. So the guidance coming into the meeting was of pause into 2025 from the pace that they've been cutting. So it wasn't a surprise. And eventually, I think they took out one cut from the market. The one thing that we wanted to be very, very clear, Doug, here is the nuances that this is not a pivot. This is not a stopping of the rate cutting path that they're on. This is slowing the pace of those rate cuts is how we took it.
Okay, slowing the pace. But one thing that Powell did tease out here was that some members of the committee are now factoring in the potential impact of higher tariffs from the incoming Trump administration. And what I understand in that is that there is the potential for even more inflation, or at least stubborn inflation beyond what we're already seeing. Is that a fair statement?
Fair statement. I think we are penciling in that the pace of decline of inflation that we have seen over the last 18 months in the US is tough to replicate in 2025, even without thinking about the pro-cyclical policies that right now the market is over exuberant about in our minds. So yes, it'll be tough to replicate that. So inflate the last bit towards their 2% mandate is going to be tough and stubborn. So yes, I think we agree with that statement. But we, on the other side, think that the market is too positive on the new administration being able to implement all the policies or agendas as we were talking about it during the election timeframe. With the amount of deficits that we are sitting on, the debt that we are sitting on as a country in the U.S. is, the math is not sustainable longer term. So we do think that the market is slightly ahead of itself in terms of the inflation worries. But yes, there is a non-zero chance that inflation could be a little bit more stubborn than what we've seen over 2024.
Vishal, I'm very curious to get your take on the U.S. economic situation right now. We had the third quarter GDP number revised, stronger than previously reported. Yes, consumer spending remains robust. That was a factor, definitely. Applications for first-time jobless claims were down last week, and existing home sales in the U.S. up 6%. I think we broke above the 4 million rate in November for the first time in 6 months. So clearly, in spite of an environment where rates have been somewhat elevated, yes, we've had the Fed adopt an easing bias recently, but I think historically we're still at much elevated rates. Historically, we're at very elevated rates right now, and still the economy seems to be holding up reasonably well.
Agree with all those points. I think the way we think about the world from our vantage point as fixed income investors, we are thinking about balance sheets. So there are three big balance sheets that we constantly focus on: the consumer, corporate, and then sovereigns or the government. And we do think that corporate and consumer balance sheets are very strong. Whether it was part of it is pointing to the stimulus that the government showed up with post-COVID or during that time in 2020, the low rates, the refinancings that happened in both the consumer and the corporate balance sheet. So I think those are strong, and the strength continues to show up in economic data. I think the weaker part of the balance sheet, as we touched on with the deficits, is the government balance sheet on the U.S. side. And I think that is what is the cause for concern, and that is what is causing the steepness of the yield curve here, where the long end is demanding a lot more yield, a lot more premium to be able to buy that for a portfolio. So coming back to the first part, we do believe that I think this 2025, we will continue to see these two balance sheets exert their power, meaning the growth being robust, growth being strong from there in terms of data. And I think that's why these higher interest rates, even now, are restrictive, but not as restrictive that they were probably at 550 when we ended the cycle with the Fed.
Vishal, let's pivot to Asia, and I think we can begin with the Bank of Japan. Not a big surprise that the BOJ yesterday left borrowing cost unchanged. I think that policy rate is at 25 basis points, which is just unbelievable that we're talking about a rate that is still considered accommodative, right? The yen gave back a great deal in New York trading. I think we're right now flirting with about 158 against the dollar. Is there the risk now that the BOJ is very far behind the curve, that it really needs to take action and to begin to raise rates?
They should be raising rates. But I think this meeting yesterday was very well telegraphed through the media outlets with the speeches, et cetera, that were given out from the administration there. We are penciling in that they are slightly behind the curve, and the market is pricing in slightly below what we think that they could and should be doing and will be doing probably in 2025. So we are underweight that front end. So we are short duration, underweight, meaning we are in flatteners in that region at the moment. And I think the only position that we have on in the currency is versus euro, rather than taking it versus the dollar, given the volatility there. So I think those are the positions that we hold on. And I think fundamentally, Doug, to go back to your question, we do think that inflation is taking a hold. And we'll get some more information, I think, later this month and probably early next year, in the first week, where you get some of these wage inflation indicators from some of the insurance companies there that will report on it. So some more information that they will have on hand for the January meeting, which we think is going to be the one that they will actually go ahead and do the hike.
So with the yen at around 158 against the greenback, I'm wondering whether you see risk of some form of intervention, let's say from the Ministry of Finance in Japan, and whether that would have the potential to create a lot more in the way of volatility, even though it may be kind of a temporary and short-term event. Is that some kind of vulnerability that the market needs to be on alert for?
I think definitely, and I think that central bank has done actually a very good job in making sure that the market knows it very clearly, some of those levels, some of the technical levels that typically they like to intervene with, the amount that they like to intervene with. And I think this is the time in the last week and a half of slightly slower trading, slightly less liquidity in the market. I think these are the times that I think the central bank will be on alert, given that it's not just looking at yen and their own policies, but then the interactions with the other central banks.
Vishal, before I let you go, I'd like to get your take on what's going on in China. We've been talking a lot recently about the Politburo and some of the messaging that authorities in China have been putting out in terms of a lot more in the way of stimulus. We don't know yet what the details are, but one of the things that seems clear is that Beijing wants to kind of catalyze the domestic demand story in China. How do you view the overall Chinese economy? And secondarily, are you seeing any opportunity in the fixed income markets in China right now?
I think the administration there has very clearly shown us the path of what their intentions are, which is to resuscitate the economy. And I think the resuscitation needs balance sheet repair is part one, which needs stimulus, and then the demand repair, which also will need stimulus. I think the estimates there of stimulus could be different from what the market expectations are versus what they've come out with. But I can see very clearly that that amount and effectuation of that stimulus is also going to be very policy dependent from the U.S. I think the U.S. new administration walks in January 6th, and I think we should be looking for some policy pointers in the first 90 days here in the U.S., which will then also guide that administration in China to come up with their programs and sizes a little bit more publicly to defend and to resuscitate that economy. So I think that is definitely a very clear path that they're setting, and that's what they will be doing in the first half and probably throughout 2025 in our minds.
So we've seen the bond markets in China perform pretty well in the fourth quarter, and I'm wondering whether or not the big moves have already happened, and perhaps there are fewer opportunities right now in the fixed income space for Chinese bonds.
I agree. I think big moves have already happened. The hedges to be placed with government yields and FX, I think, have already gone through in the market. So we are finding less opportunities at this point. And then I think the stimulus and guidance from that will drive some of the clarity that we need on the credit side of investing on fixed income in the region.
Vishal, we'll leave it there. Thank you so much for being with us. Vishal Khanduja, head of broad markets, fixed income at Morgan Stanley Investment Management, joining us from Boston here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.